equity market performance is going to follow those earnings growth. Typically, the S&P is tracking the earnings growth, and that's what's ultimately driving markets and driving returns. And so for us, it really all starts with data collection. So our investment team is looking at hundreds of different data points every day, and it's all the data points that you're talking about, seeing in the headlines, all of the noise that we're all reading about and watching on, news outlets each and every day. They're looking at that, and then they're going, 30, 50, 70 layers deeper into those data points to really analyze and get to the root of what is actually driving this data. What are leading economic indicators telling us in terms of where the economy is right now, but also where are we heading in the next 6 to 18 months? That's really how we invest, and that's how we make our active allocations in our portfolios, is within that 6 to 18 month time frame. So once they have that outlook in place, they're going to then look at areas of the market that are in a position to perform very well in that time horizon. So going to experience some nice tailwinds, given the market backdrop. And then we're going to completely avoid or sidestep those areas that are going to be facing significant headwinds in that time. And so, Mark, as you know, how we do that when we're talking about the U.S. in particular is through sectors. And so, as I'm sure everybody on the call knows, there's 11 sectors in the S&P. And what we've done, this is a blueprint, this chart right here, but we've sort of kind of broken a typical economic cycle into 3 phases: early, middle, and late. And then we bucketed each of those 11 sectors into one of those phases. And so really, it's pretty simple, not simple to implement, but each phase of an economic cycle has some characteristics that kind of define that economic phase. So early on in a cycle would be when we're coming out of a recession. There's a lot of pent-up demand in the economy. And so sectors like materials, energy, financials, industrials, real estate, the companies in those sectors tend to do really well in that type of environment when there's this really strong growth in the economy, anticipated growth ahead. And so these 5 in the light blue here are what we would say are early phase sectors. Moving on, then the sectors in the dark blue, this consumer discretionary, tech, comm services, those are what we say are mid-phase sectors. So, economy is kind of maturing, tracking along. The consumer's really confident, so they're spending a lot of money. Companies are really, confident in spending. They're putting a lot of money into, creating efficiencies with technologies in their businesses. So those types of companies that fall into those categories do really well in that mid-phase type of environment. And then, opposite end of the spectrum, healthcare, staples, and utilities, those are the more defensive sectors. And so, those are companies that even if we are going to be in a period ahead of slowing growth, even if there's a recession on the horizon, I mean, we all know you have to go to Walmart and buy paper towels. You have to go to the doctor if you're sick. You have to turn on the heat in the wintertime. So those companies are going to hold up well, even in a slower growth environment. And so what we do at WestEnd is we typically are going to allocate to usually 5 to 7 of those sectors at any given time. And then we're going to completely avoid the rest. And those the sector ownership will shift as the economy shifts and progresses. And so, over an entire economic cycle, we'll own all 11 sectors, just never all at the same time. And I bring that up, before I get into kind of what's been, driving markets and where are we right now, just to provide that background, because it's very, very much tied to where we are actively allocated currently. This is just, and I know, Mark, you're going to circulate this deck following this, but this is just, I think this chart does a really great example of kind of helping to conceptualize the types of companies that fall into these different sectors. And so we just feel like it's a very, the sectors are a bit more nuanced than, typical growth versus value type of investing. So we can really isolate the particular areas given each, each particular economic cycle that we're in, we can really isolate those areas that, hey, we really want to capture returns in these sectors, or we really want to avoid this area of the market. I'll pause there if there's any questions on any of that, or if you want to kind of clarify anything there before I go on, Mark.
No, I think maybe just a quick recap on what you said, Emily. So WestEnd's philosophy is that for each phase of the economic cycle, there are certain sectors that y'all want to overweight or underweight, or in other words, have exposure to or avoid. Um, Again, depending on where we are in that cycle. And y'all's process really hinges just around what phase are we in the economic cycle. So perfect.
Exactly.
No. So maybe spoiler alert, you might be expecting this question, but so where are we now?
Yes, I'm so glad you asked. So glad you asked. So we would say right now we are in the later stage of this economic cycle, and that's where, this kind of caveat or disclaimer at the bottom of the chart, evolution of a typical cycle comes into play, because while we are, very much analyzing all of those different data points that I talked about a few minutes ago, there's a very qualitative approach to our process as well. And we've been around since 1996, so the team's navigated through almost 3 decades of economic cycles, and now the sixth presidential election cycle. And so seen it all at this point, although I guess after the past few years, I don't know if you can ever really say that you've seen it all, but we've seen a lot. And so even though we think we are in the later stages of this cycle, that doesn't mean that all we're owning are healthcare staples and utilities. We are, as I said, forward looking, and our job is to protect portfolios from those areas that you don't want to be invested in, that when they aren't doing well. But it's also to obviously generate really great returns for our clients. And so we are very opportunistic in that forward looking analysis piece of our process. And so, each cycle is different. This isn't gonna, sector leadership isn't gonna follow this exact map every single step of the way. So, I'm gonna skip actually ahead quickly to our current allocations, then we'll come back to some election conversations in just a minute. But is it not in this? I'll come back to it. So right now, like I said, we have some late phase exposure. We're overweight these later phase, more traditionally defensive sectors, healthcare staples and utilities. We also have some exposure in these mid phase areas. I think probably people are aware, up until the past few months, really all of last year and the first half of this year, the Mag 7 led the way. That was the only thing that was working. It's why the S&P is up another, 20 or so odd points so far year to date until the past couple of months. Those were the only kind of 3 areas that were contributing to that. But, coming into the year in anticipation of rate cuts that have now started, we added a financials position. We also recently added a real estate position. Both of those sectors tend to do really well in a falling rate environment, as do utilities. And all 3 of those sectors have done very well thus far this year. Because we do think we're later stages in the cycle, just think there's still room for the economy to grow. We're not saying there's a recession that's imminent, but we are still avoiding some of those most volatile, cyclical, early phase sectors like materials and industrials and energy right now.
I just want to know for next year what stupid nickname Wall Street's going to come up with for these like 7 or 8 companies. So
that I don't know. Maybe that can be a poll. We can take a vote, and then we'll see. We'll come back next week, see who's yeah, who knows? Who knows?
Yeah, just so that just to expand on the Mag 7 reference. So there's been a subset, Emily, as you well know, of 7 or 8 companies that for the better part of a decade have just run away with performance and drugged the S&P 500 higher. Facebook, Apple, Netflix, Microsoft, Amazon, Google, and now you add Nvidia to that because the AI just craze that's gone on. Random factoid, but I think a stat that I heard is Nvidia this year alone accounts for like 25% of the S&P 500's performance. It's insane.
That is correct.
So, um,
And
yeah,
tech is as of, I think as of Monday, is like 32 or 33% of the S&P. And so, again, we want to take part in that. And we wouldn't have performed as well as we have if we didn't own those names in those sectors that those names fall into. But from a risk standpoint, you will never find us only owning two sectors. And it's really not realistic to anticipate that type of narrow leadership for any length of time. And actually, I'm going to switch over to one slide I just want to highlight here, which directly speaks to that I think is really powerful when looking at the what we've seen so far. And it's talking about that sector leadership. So the chart at the top of the page here. This is showing sector leadership going back to 1990. And so the dotted line at 5, so on average, any given year, there's usually around 5 sectors that are outperforming the S&P. So if the S&P returns 20%, usually 5 are performing, 20% or better, and the other 5 are underperforming that. Obviously that varies some, year over year. This year, all of last year and the first part of this year, we saw 2, and at some points, briefly 3 sectors outperforming the S&P. The last time that we had that narrow of a leadership was back in 2000, right before the tech bubble burst. So it's just all that to say, WestEnd's process really shines in environments where we have that sector dispersion, and typically in a typical year, the top 5 sectors versus the bottom 5 sectors have about a 21-22% performance differential. Obviously that has not been the case in the past, couple of years here, but what we've started to see, since probably around July timeframe of this year, is that leadership is starting to broaden out. There's still a lot more room for that to broaden out. But Q3, there were 8 sectors that outperformed the S&P versus, those 2 or 3 that we'd seen, in the past year and a half before that. So we're starting to see that. And as that, starts to take off, that's what we're really positioned for in terms of, outperformance. We're ready to take advantage of that.
well, the dominance of tech this year has definitely been on display.
That's right. That's right.
um, well, I guess, Emily, so quick recap. Basically, all year, right? What I heard you say is that what's been driving markets is the Mag 7 in tech, really.
Until the past couple months. Yeah.
Yeah,
Exactly.
sorry. Yeah, you did say to the last couple months. Um, so is that indicative of us being kind of in that late stage growth cycle from a macro standpoint?
So it's really, in terms of, I guess, why that happened, I think there were a lot of things that went into that, I guess, kind of perfect storm that caused that narrowness of leadership. And a lot of it was the continued strength of the consumer, continued strength of the economy. I mean, it was much more resilient, I think, than anyone would have anticipated. If you were thinking back to like 2022, I don't think anybody anticipated the resiliency that we saw since then. And look, like I said, we're not saying that we are anticipating a recession necessarily. We're just saying there's not really a lot of slack left in the economy at this point. So when we're looking at things like labor market statistics and we're looking at, at the varying profits, and earnings that companies are starting to report, there's areas of opportunity and there's areas of strength, like, and I mentioned financials as being one, real estate as being one, utilities done really well so far this year. But there's just a lot of, I guess, bolsters to the economy that really were still left over from COVID in terms of excess savings that were helping contribute to this consumer's ability to keep spending. Just a lot of the government assistance that we saw, all of that takes a while to really filter through the economy and completely disseminate. And so while we don't think that it's necessarily that we should be battening down the hatches and, being all in defensive, a lot of that we have now seen start to completely play out, so that now we're really back to operating as normal, or as normal as we are, I guess, in this day and age. But I mean, another example of that would be the labor market. So, I think a lot of people point to the resiliency of the labor market that we've seen, in recent quarters. And one thing that we were looking at in terms of jobs growth was, yeah, but where is a lot of that job growth coming from? And a lot of it was coming from healthcare and from, which obviously was decimated after COVID. And so that took some time to add those jobs back in. A lot of those jobs came from government and like teaching related jobs. And so again, as those have all now normalized those levels, the job growth is slower at this point. It's not as robust. It's not all like sunshine and roses that picture would paint if you're just looking at that overall data point. So again, we're still in a good place. Later stage of the cycle, still some room to grow. But there's certainly areas that we want to be avoiding going forward, at least in the next 6 to 18 months. And then areas that, we're overweight and really excited about.
Awesome.
Mm-hmm.
Well, I guess that maybe tees up the next question that we've already talked about. Spoiler alert. But what expectations about the balance of this year and the early part of next year? If there is an expectation at all to be had, nobody has a crystal ball, right?
Yeah.
We've got an election, and I just hope we know who won, like in short order after.
Yeah.
That's all I'm praying for, is that we know who won. But
Right.
What are I don't even know how to phrase this question right now, but I guess, what's the outlook over the next, let's just say, the balance of the year to start next year, the early part of next year?
Yeah, no, it's a great question. And I mean, I know that it comes up in almost every conversation I have, and we're less than a month out now from the election. So I don't know if we're less than a month out from knowing who wins the election, to your point, but we'll see. So, in terms of, how we think about elections, or really any socioeconomic events that are happening, we're not trying to predict the election. We are, at the end of the day, we're investors, not economists. And, we don't have a crystal ball. If we did, we'd all be on a private island somewhere, right? But what we do know is that, oh dear, hang on, sorry. Let me make sure this is showing the right slides. There we go. This is what I wanted. What we do know is really coming back to how we think about any time, any economic cycle. It is the macroeconomic environment, not the election outcome, that's going to drive returns. So in terms of what are we thinking is going to happen the rest of this year? What are we thinking is going to happen next year if Trump wins versus if Harris wins? It's ultimately the macro environment that's gonna be driving those returns. And so, I think everyone has probably seen or read some iteration of these first kind of 2 points on this chart, where if you look at the market returns, election year versus non-election year, they're basically the same. Where what's different is if you look at an election year where there's a recession versus an election year where there's not a recession. Very, very different numbers. And so, again, there very well can and oftentimes is some volatility around elections. We would expect that. But that's usually short-lived. It's usually not going to dramatically affect the overall economic outlook. It's actually, it will most likely not affect the overall economic outlook. And even within specific policies and thereby, sectors that may come in and out of favor depending on, who is in office. That takes time to play out too. Washington does not get anything done quickly. It's going to take some time for changes to be made if there are changes made. And so I think one other thing that I find really interesting is when we look at this. This is I call this a sand chart. So this just shows our overall exposure to those early, middle, and late phase sectors over time. And so the green is the late phase, the blue is the mid phase, and the orangey red are those early phase sectors. And what's interesting, if you look down here, where, we've circled all of the presidential election years, there's not usually a lot of change in what we are allocating to around elections. And that's because any changes or shifts in our allocations that we're making, we might end up making some shifts depending on, who's in office, but they're going to be made within our investment time horizon, that same 6 to 18 month time period. And kind of a good example that I like to point to for this is 2016. So 2016 was sort of a surprise Republican sweep. There was a lot of volatility, if you remember, for those few months following the election, Q4. A lot of those early phase sectors took off because people were anticipating, a reacceleration of a lot of these different areas of the market, given the Republican sweep that happened, and we didn't have a lot of those early phase or any of those early phase sectors, and that hurt for that 3-month period for the end of that year. But our process is let the market digest this. Let's really examine the rhetoric that's coming out of this. Let's really kind of identify what is actually going to change in terms of policy, what is actually going to change in terms of if that's going to affect what companies do well, and, what changes do we need to make. We ended up adding some to financials following that period here in 2017. But we didn't chase after all of those early phase sectors. And 3 of those sectors ultimately ended up being 3 of the worst performing sectors in 2017. So really all that to say, we aren't making these knee-jerk reactions. We're not chasing these short-term, volatile pops and sentiment-driven trades, because ultimately it comes back to the macro environment, and that's what's really going to matter in the long run.
I almost pulled a Zoom newbie trick and didn't unmute my mic. So, quick recap. So, elections matter to us for our deeply held political convictions, but Wall Street could care less. Maybe adding something that I don't know that you said, but you implied it. Wall Street cares more about earnings than they care about politics at the end of the day. Something I've tried to adopt. I know, right? Something I've tried to adopt is in thinking about, let's say, elections and markets, is there's the economy over here on this hand, and then you've got the direction of the country, which is politics on this hand. Those 2 things are totally different, but we oftentimes put our view of the direction of the country. We see the way that the markets are going or going to go through the lens of where our country is headed. And those 2 things are not correlated per se. Companies can still make money regardless of who's in office. It's what companies do best. They figure out how to make money. And I think the last numbers I saw, Emily, on this were that, to your point, Wall Street is trying to parse and digest the outlook for earnings. But the last numbers I think I heard were that earnings growth is still forecast to be like around plus 10% by the end of the year. And then next year, like plus 15 is the expectation. Now, whether it happens or not, we'll see. But that's at least the expectation that I heard, or the forecast anyways, is what I heard. And to your point, if that's the case and the economy is still chugging along strong, then the election is just static.
That's right. Well, very well put. And I think we've seen that so far this year with look where the S&P is. And I would say, it's got to be one of, if not the most, um, I just like heated personally, and emotional, I guess just impacts and reactions and thoughts on both sides of the aisle, where you have very, very strong opinions on both sides of, this is going to be amazing if this person wins, and this is going to be terrible if this person wins. I mean, it's very, very strong, high conviction on both sides. And yet, even with all of those jitters, the S&P is at up 22% this year. So, I mean, clearly the markets do not, they're not going to take that into account long term.
Yeah, no, and I think that's a great thing to remember. Is that normally with any volatility centered around election issues, it's short lived. It's something to manage your way through. Understand that it's probably going to happen. It is helpful, right, to manage expectations.
Mm-hmm.
Behaviorally, I think we do better when we can anticipate what's coming. So, yeah, we'll see. Like I said, on the whole election front, I just hope we know who wins in short
Yes.
order.
Yes.
That's I think what Wall Street would like as well.
Yes. Yes. And I will say too, I mean, so, we 100%, we want to stay invested. We think there's areas of opportunities. Everything that we just said, any volatility is typically short-lived. However, it is our job and to do the work and think of all of the different possible scenarios and outcomes. And we do this all of the time. The teams, they're constantly playing devil's advocate of, okay, so we think that we're late stage in the cycle. We think we should be overweight this, this, and this. We think we should have exposure here. Well, what if we're wrong? And like, what does that look like? And what is the, like, I mean, it's constant, right? And we're doing the same thing. We're not acting on it right now, but we have come up with, okay, what are the most likely scenarios of playing out of this election? And what is that going to mean from a sector standpoint? So to us, two most likely scenarios are either there could be a Trump win with a Republican sweep, or there could be a Harris win, but with a divided government. I think that it would be a surprise to us if there was a Democratic sweep at this point, just given current numbers. And so what we've done is then say, all right, well, what does that really look like in terms of sector allocations? What are positives and negatives in both scenarios? And so, I mean, a lot of things are, there's pluses and minuses on each side. Most things with the Harris win and divided government, it would probably be a lot of the same. There could be some shifts in financials if there's tax cuts in a Trump win, of course, but then there could also be, raising of tariffs. So then what is that effect going to be? How much of an effect is that going to have on the consumer? Healthcare is a very, it's probably the most politically impacted maybe of all of the sectors, certainly one of the most. And so, we're constantly looking at really just all of these different variables. But point being, the team's doing all of the work to analyze and have all of these different base case scenarios. Again, we'll wait and see whenever we do get the results confirmed. We'll see what that rhetoric looks like. We'll then be making the decision on if we need to make shifts, what are those shifts, and what's the best course of action to be making those shifts. So I know this, Mark, but for clients on the call, when we are making changes in our allocations, we typically do so in a gradual incremental basis. So we're usually phasing in and out of sectors, usually by like a 2.5 or 5% trade at a time. It would be highly unlikely for us to, have a 20% allocation to healthcare and then overnight have zero. We're going to be shifting and phasing in and out of those sectors as the economy shifts. And then, in any case, regardless of the reasons specifically why we're making those changes.
Always unmute the mic.
Yes.
Just about did it again. Well, so appreciate the insights, Emily. And I mean, you guys always do a phenomenal job of trying to think through all of the what if scenarios and come up with a game plan. y'all do a phenomenal job of thinking through those issues. Um, Before we wrap up, I just want to ask maybe a couple questions about some other isolated, singular issues that could have an impact on markets, while also buying time for any questions to go into the Q&A and text chat area as well. So if there are questions, feel free to load those in, and happy to try to get those answered. I know geopolitical tensions are kind of a big deal right now. Iran seems to be wanting to get into the mix with Israel, and Hamas in the Middle East continues to be a hotbed. I don't know that it ever really quiets down. We just don't hear about it as much. But
Mm.
um, then you have Russia, China, all the issues that continue to stir between ongoing war with Russia, Ukraine, China now getting more and more aggressive towards Taiwan, and what impact, if any, are geopolitical tensions going to have on markets in the coming, let's just say, I don't know, like 6 to 18 months, if
Mhm.
any impact?
Mhm. Mhm. I mean, they certainly could, especially, if we're looking at like a sector like energy, that could certainly be affected by many of those tensions. How we think about international equities, we look at things on a regional basis. So we're not getting country by country specific when we're making those allocations. We're looking at where is that region generally in their own economic cycle? What sectors comprise the majority of their GDP? And then, based on that, do we want to invest in those areas at this time, or do we want to underweight or avoid those areas? So for us right now, and has been for a while, our only international overweight is to developed Asia, which is essentially Japan. We are underweight Europe still. That's something that that's maybe an area that we're looking at closely. Currently, we do not have any direct exposure to China right now, have not for quite some time. And so I think there are certainly some sectors that could, like I said, like energy, like industrials. I mean, there's some areas that we're keeping a close eye on. Again, we're not going to invest around those socio-political events, but it's certainly between different policies with imports and exports, and certainly within certain sectors that could be changing. It's something we're keeping an eye on, but it would be again something I wouldn't expect hasty trades in and out or shifts in allocations based on that.
So maybe in summary, potential impact, but up in the air.
Up in the air. Still, I mean, still favor the US over international as a
Yeah.
whole. And then just like in, the US with sectors, there are some areas of opportunity internationally. We're going to only be invested in those areas that we feel, have that opportunity. We're going to be avoiding those areas that are, facing headwinds in that time frame.
I did like what you said. I did like what you said about the potential for any of these geopolitical tensions to cause some isolated friction points like energy, as an example. So, cost of heating and cooling our homes, gas, transportation, etc. Um, a saying that I've heard many use is that so long as all of the tensions stay over there, that sounds very callous. I don't intend it to be callous, but so long as it stays over there, there's very little impact to us here as far as the U.S. economy goes, um, which means consumers can keep spending, which is 70% of our GDP,
Mhm.
and earnings foreseeably would continue chugging along. There might be some disruption as far as supplies, cost inputs, et cetera, by oil and gas, et cetera. But I really did like what you said about the potential for isolated impacts to certain things versus a more widespread impact per se.
That's right.